Well, stocks bolted out of the gate at the opening bell, and then, panic buying sent shares bolting higher into the closing bell. Lots of factors to this market, including fear of missing out. But perhaps the most important thing was a glance at next week's debut of the new Fed Chairman, Jerome J. Powell. The release of the semi-annual summary of economic projections to the U.S. Congress ahead of that testimony was a surprise. I dare say it was really Goldilocks-like. The Fed now sharpening its pencil and reacting to obvious trends and momentum in the economy. They see a stronger GDP than they did before. They see lower unemployment than they did before. But the core personal consumption expenditure price index, how they measure inflation, remains unchanged. So the late spurt, not only was it positive because it happened on a Friday, but major indices took out key technical resistance points as well. Then there was also a shift in market breadth. You see new highs that continue to edge out new lows here in the last few sessions. By the way, each of the S&P sectors rallied higher. Utilities leading the pack, perhaps underscoring cautious optimism. Still, this was a great session. The question now, are we out of the woods? Joining me now, David Nelson, the chief strategist at Belpointe Asset Management, and back with us is Gary Kaltbaum in the studio. My man. Yes. I got to start with you. I mean, this is a heck of a session. Did we learn anything?
Well, look, intermediate term corrections usually take the market down 10 to 15%, but actually last about 90 days. This one lasted 10. And on February 9th, I thought ALO was put in. That was the day the market was down 400, finished up 400. I thought sellers petered out. But I think it was the low. We're getting stronger as we move higher. And the one thing I'm always watching, actually two things, financials strong, and the big leading growth names are really starting to heat up again. And nothing bad ever happens when that happens. And the fact that we finished so well on a Friday is darn good news. It's the best Friday we've had in 2 years.
David, some folks were thinking, hey, we got to test this low, though, that was established. It's a healthy thing. You go, you test it, you make sure strong hands are still strong. Does that still have to happen?
It doesn't have to happen. You know, there are so many technicians out there. Everybody thinks that's what's going to happen. Maybe the pain trade is up. Gary brings up some pretty big points here. You know, we're talking about a correction. It was vicious. The time compression is probably uncomfortable. It's a computer-driven world. Everything happens at light speed, but we don't necessarily have to test that low. We're so concerned about wage inflation. Charles, you and I have talked about it. You know, we've been fighting for wage inflation for the last decade. Now that we finally got it, we're terrified of it. And I don't think we should be. It doesn't necessarily translate into a lot higher headline inflation somewhere down the road.
Let's talk real quick then, guys, about the composition of the market so far. Amazon and Netflix, almost half of the gains. I mean, just these two stocks carrying almost the entire load for the S&P 500. Is that a good or bad thing, David?
I don't think it's all that surprising. You know, Amazon has been a pretty strong stock, but industrials are doing fantastic, and that's the heart of this Trump economy. I'm pretty excited about that. There's a lot of stocks in the value sector that are doing well. We always point to Amazon. We always point to Facebook. For me, those are the new consumer staples. I don't want them to be the leading indicator moving forward. I want to see these other names pick up.
Gary?
I don't think it's just Amazon and Netflix. I have a list of 50 to 100 big growth names that are really acting well, held great support, and are just popping in the last few days, something like an Adobe Systems. But also, as I said, the financials. Nothing bad ever happens when financials are acting well. And even as interest rates tick up, they worked. And by the way, I want to add one more thing. Everybody's been talking and worried about interest rates. I think interest rates may have topped out in the last couple of days and maybe headed back down in the 10-year, maybe to 2.5, 2.6, and we'll stay in this range.
Wouldn't it be something if we don't hit 3%? I mean, for all of the fear-mongering about 3%.
We got close, and I think for this second, look, we can go higher.
Sure.
But I'm not worried. If we go to 3.25, no biggie. We were there a couple of years ago, and the world did not end.
Real quick, then, the Federal Reserve, Jay Powell makes his debut to the world. Unfortunately, it's with senators and congressmen asking him dumb questions. Nevertheless, we may get a glimpse into his mindset because all of a sudden, people on Wall Street are acting like he's a complete mystery.
Well, dumb questions isn't the word when it comes to what we hear during the Fed time. I think he's going to be easy. I don't think I think he's smart enough not to roil markets. And if you listen to Trump, he likes lower interest rates also. So I think he's going to talk like Yellen's been talking lately. Oh, maybe a few more to the upside, but we'll wait till information comes in.
Right. Real quick, Dave, I'm getting a wrap signal.
Yeah, I got to take the other side. I got to take the other side of that. I don't think the Fed can necessarily. They can control the short end of the curve. the long end of the curve is going to be on its own. We'll see what happens there.
I know you're going to that Ronald Reagan dinner, man. Bring me back a doggy bag. All right, guys.
Yeah,
Thank you both very much. All right.